I'm Darius McDermott from Fund Calibre, and I'm delighted to be joined by Matthew Page and Dr. Ian Mortimer, co-managers of the Guinness Global Equity Income Fund, which is elite rated by Fund Calibre. Guys, good afternoon. How are you?
Very well, thanks. How are you doing?
Yeah, great, thanks.
Yeah, not bad. Listen, firstly, huge congratulations having just passed the 10th anniversary on the Global Income Fund. What have been the highs and lows on the last decade, and what, if anything, has changed in the world of equity income in that time?
Yeah, thanks, Darius. It's great that we finally passed our 10-year anniversary. It's sort of flown by, really. Launched the fund at the end of New Year's Eve 2010. I guess the first thing is global equity income, when we launched, was not necessarily the best known sector. I think particularly in the UK market, everyone was very focused on UK income, and kind of going global was not necessarily seen as the best option. And I think what we've seen over the last decade is really the benefits of that coming through really strongly. Having access to more growth areas such as the US, companies such as in Asia becoming more progressive in terms of their dividend policies, and also really benefiting from maybe the diversification across sectors as well. So the UK income's always suffered with a pretty high concentration in whether it's banking or commodities. So having that wider exposure within the global equity income space has really allowed us, I think, to find the best opportunities, to find those companies that could maybe more successfully grow their dividend sustainably through different periods. And then, ultimately, we're really pleased that we finished the year of our 10-year anniversary with the best performing track record, which is fantastic, and have grown the fund and really brought a lot of supporters along with us. So for that, we're really grateful.
Yeah, I mean, the performance has been exceptional, so congratulations on that as well. Matthew, maybe you'd like to talk us through then the next 10 years. It's easy to look back, but how does it look forward, and where do you see, with a reasonable time view lens, the best income opportunities in the coming years?
Yeah, well, I mean, the last 10 years, as you say, sort of had its challenges in terms of, coming out of the sovereign debt, the financial crisis, and then, the European sovereign debt crisis, and there've been all sorts of events. So I think we have to go into the next 10 years knowing there's going to be some difficulties along the way, and therefore, really, it's about building a portfolio, that's going to be able to weather whatever gets thrown at it over the course of the next 10 years. So for us, that means really, continue to focus what we have been doing, which is, continue to look for companies that can consistently generate high levels of profitability and can reinvest that into their business to grow, which in turn means they're going to be able to, grow their dividends over the next 10 years. And so if you think about areas where, you might be able to find that growth over the next 10 years, you're going to have a split between those that are more steady eddy consumer staple type businesses that are constantly managing to grow but at a relatively modest rate, and those companies that are maybe more oriented towards the changes that are going to happen over the next 10 years, particularly in the IT sector or the industrial sector, where companies tend to be particularly in the IT sector, highly profitable and very cash generative. And as those companies mature, they will be able to distribute dividends to investors.
Let's focus then on dividends. As we know, 2020 was a tough year for dividend stocks generally as they came under pressure with the pandemic. What's your view on dividends in the year ahead? Do you think extended lockdowns will mean those return to dividend payers or increased dividends are pushed back further, or are you optimistic for 2021 on dividends?
Yeah, ultimately, when we look at our portfolio, we're pretty optimistic. I think when we look at 2020, you're absolutely right that the dividend style or factor, if you like, was really under a lot of pressure. We saw these kind of big sort of economic sudden stops. We saw a lot of kind of regulatory pressure in certain sectors, particularly banking sector, for example. And if we look across, whether it's the FTSE 100 or the Euro stocks, significant dividend cuts at the index level of sort of 30, 40%. However, that's pretty concentrated. In fact, if you look through lots of different areas and through the lens we look at, particularly focusing on companies with strong balance sheets, there were many companies that actually got through 2020 perfectly well, actually managed to grow their dividend, in fact. We look at our portfolio, we've got 35 stocks we invest in. None of our companies completely cancelled their dividend last year. We had one company reduce their dividend. We had 6 that were flat, and we actually had 28 companies that grew it. And the overall distribution from the portfolio was essentially flat year on year. So there's definitely pockets of the market where they did not suffer those big dividend cuts. If we then look forward to 2021, I think absolutely some of the big companies, particularly from the regulatory pressure, might start to bring their dividends back. But actually, when you look at the expectations for, say, the FTSE or the Euro stocks, for example, you actually don't see an expectation that the dividend will get back to the 2019 level until maybe 2022 or even 2023 or beyond. However, again, if you look at companies such as the things we're looking for, if they got through 2020 perfectly well, then I think 2020 should be fine. And when we're starting to see some of the companies we own announce what their dividend action is going to be this year, which we've already started to see, generally speaking, we're seeing sort of dividends that are surprising to the upside for some of the companies we're looking at. So I think it's all about thinking, where are you looking, what type of sectors, and also the level of the yield that you would like to get. Very high dividend yield companies are really the ones that are often being cutting because they maybe couldn't sustain it. If you've got a slightly more moderate yield approach, I think you've got a much better chance to be able to grow that in this year and beyond.
Thank you. So another area which is very topical, sort of bubbles in investments, we've seen Bitcoin and other assets, technology, for instance, or large cap tech in the US. But what's your view on sort of stock markets? Are they overextended, or is again that a sector by sector type of question and valuations?
Yeah, I think there are certainly pockets of potential overvaluation, but I think more broadly, you've got to consider the fact, we've had massive cuts in interest rates. We've had huge amounts of liquidity provided by central banks. You're going to have huge fiscal stimulus coming out of the US and and Europe over the course of the next 12 months. And you've got companies that have been adapting and innovating to the circumstances that they have experienced. And that in turn is going to generate, alongside the vaccine rollout and the return to some sort of new normal, there's a huge amount of pent-up demand from the consumer to get out and get back to restaurants, to go out and go on holiday, to spend, if you like. And I think that's going to lead to some dramatic economic growth over the next few years. And so I think you do have to be selective. I think you've got to cherry pick your way through this market and avoid some of the pitfalls. But broadly speaking, I think there is still upside to equity markets.
Another area where there's an increasing focus is sustainability and ESG investing. Do you see that as an opportunity for the fund or a headwind? How's that whole, not just with respect to how you pick your own stocks, but how that whole sort of dynamic is changing the investment opportunity?
Yeah, no, you're absolutely right. It's been a very big focus for investors. Clearly, a lot of those approaches performed very strongly last year, and I think if you've just had a period of strong performance, then clearly lots of people like to look at it, try and understand why. I think firstly we would say it does feel like to us that there's potential for moving on from your last question, that there are some pockets that maybe there are some overvaluations for people kind of chasing some of these companies that have the best exposure. I think whether it's overvaluation or it's maybe seen as sort of baking in much higher expectations that therefore these companies may have to maintain, which is obviously difficult. That's one big risk. But I think generally what we found though is, because our approach really starts with quality, so kind of high return on capital, for example, what we've actually found is that correlates quite strongly with actually quite well-run businesses. And so things like governance, in terms of the score, if you like, are really quite positive for a lot of the companies we're looking at. And I think that also then drives a lot of thought processes towards the sustainability in general, not just of the business itself, if you like. So generally speaking, I think our approach has been a good one, and we find you're in a good starting point. I think the opportunity we see is that there's certainly some companies that maybe score more poorly on some of these metrics because disclosures at the moment are pretty poor, kind of in general, and often that's the case in areas such as Asia or emerging markets where it's maybe a little bit behind. And I think what we're always trying to do is try and look through some of those headline numbers and think about, well, maybe if a company is scoring maybe slightly or poorly on that, we know it's a good quality business, and maybe we can look at maybe some of the metrics they're not disclosing yet and get comfortable that, well, if they did, I think they could do that quite easily. Then actually that kind of momentum of the direction of travel of some of those scores, I think can provide a good opportunity if you can sort of see that a little bit earlier. Obviously, that's something we try and integrate in terms of our investment process sort of as much as we possibly can.
Ian, Matt, thank you very much for your time. For more information on the Guinness Global Equity Income Fund, please visit fundcalibre.com.